Hello, everybody, and welcome. Hopefully, you can hear us and see us okay. We are very excited to spend the next 30 to 45 minutes with you. We have a great topic today that is relevant for every real estate professional, whether you're an agent, whether you're a broker, or whether you're a mortgage lender. And I can't think of a better person to have this discussion with than Danielle Pollock. Danielle has been in the business for over 20 years. Matter of fact, over 25 years. Danielle, you and I have worked together for nearly 10 years. And what I love
Mhm.
about Danielle is she's the most knowledgeable person in the mortgage space. And she has an ability to talk about certain things like what's happening with the political election and maybe wars and how they impact mortgage rates. But you're never going to know her political position. And she has that ability to articulate it from that perspective. Danielle, welcome. We're so glad to have you.
Thank you so much, Rick. I absolutely appreciate it.
So guys and gals, here's why we're having this discussion. If you realize that since the Fed changed the rate, it reduced the rate in September of 2024, you and I are living in a different era of real estate, And frankly, you and I have only lived through 4 years. If you've been in the business for 20 years, going all the way back to 2000, which I know, Danielle, you and I were in the business in the early 2000s, but a lot of people who are on this call are new to the industry or newer to the industry. And I would say that we're in era 4.0 when it comes to real estate as a result of what Jerome Powell did with the Fed rate in September of 2024. Let me give you just a little context so you know where I'm coming from. First, in January of 2001, what was happening? It was a dot-com bubble, economic turmoil. That was when the Fed issued, I think, era 1.0, when they began a series of rate reductions. If you were in the business in 2001, 2002, 2003, 2004, it was a hot real estate market. Prices were appreciating. Mortgages were very competitive. People were entering into the business, a lot of first-time home buyers. Then we saw in September of 2007, what was happening. Okay, think October 2008, September 2007. It was the real estate financial crisis, the housing bubble, the mortgage crisis, the subprime crisis. Danielle, you and I lived through that one too. And the Fed issued a series of rate reductions. They initiated it. And that initiation started real estate 2.0 all the way back in 2007. Then in March 2020, everyone on the call knows what was happening in March 2020. That was COVID. That was the third time in the 2000s that the Fed initiated a series of rate reductions. Danielle, you and I went on to coin that phrase that it was a COVID special, right? Home values were going up 20, 30, 40% in some markets. They were breaking ceilings in your market and my market all across the country. Prices were going up. Rates were extremely competitive. They were very low. And that kicked off an entire era, what I call 3.0 of the real estate industry. And in September 2024, just last month, about almost 30 days ago, the Fed began its rate reduction and reduced the Fed rate by 50 basis points, which was a little bigger than what most people expected, which kicked off the real estate era 4.0. And each time that we go back in time over the last 25 years, and we see the Fed make these series of reductions, we see it have significant impacts on the real estate market. And here's my challenge for you today, and the question we hope to bring answers to. How does the real estate agent become the point of contact, the person who's communicating to their friends, their family member, their sphere of influence about what's happening and about this new era of real estate? Why are real estate agents leaving it to CNN or Fox News or CNBC or even the Wall Street Journal to educate your clients on what's happening in the local micro markets in your community? Why do we leave it up to Zillow, who doesn't know whether to be on the left side of the tracks or the right side of the tracks because they don't even know where the tracks are in your community? So the objective here today is to help you understand what's really happening in real estate 4.0, this new era of real estate that we're now experiencing. The last time we saw this was over 1,500 days ago. 4 years ago was the last time we saw the Fed begin this initiate rate reduction. We want to educate you on what it is, how it impacts you and your clients. And most importantly, we'll cover scripts and dialogues today on how you and I can communicate this message clearly to our family and friends. So Danielle, walk us through what our agenda is today.
Absolutely. So I'm going to talk about more of the technical stuff. What does a Fed rate cut mean? How does it impact different market segments? How do you explain that to your clients? What are the opportunities? And then Rick is going to talk about the most important part, which is how you share that information and how you monetize it, how you take the opportunities in the market and you turn it into actual cash. So that's what we're going to talk about today. So I'll start with the technical piece. So let's talk about that face. And I think we all know that face, right? This is that face when the client heard that the Fed has cut the rates and they think that COVID special of 3% is back again, right? Then you know that face if you're a real estate agent and the Fed cuts the rates and you aren't sure how exactly to explain it perfectly to your clients or what that opportunity is. And then if you have teenage kids, you really know that third face because you see that probably 15 times a day, right? Maybe with some eye rolls in it. But that's the face if you're a loan officer and your phone is blowing up and you have to explain all of the above and that rates aren't at 3% and they likely never will be again. So we all know that face in one way, shape, or form. So let's talk about what a Federal Reserve cut means. So the Federal Reserve, basically controls the short-term rates that banks borrow money at from each other. So that's also known as prime rate. So often you hear that the Fed is going to cut rates, and what does that mean? Believe it or not, it is actually not tied to mortgage rates. So what it is tied with is short-term debt, such as home equity lines, such as credit cards, such as student loans, such as auto loans. So like Rick said, when the Fed just cut rates last month, 0.5%, although most people thought that we were now giving away money, we actually saw the opposite happen in the market because it's a lagging indicator to rates. So what that means, and I'll give you an example of that, is the rates were actually at about 8% in February. And then we saw them come all the way down into the high fives and the low sixes. And then the Fed spoke. And then they actually popped back up. But it was because of economic reports showing that the economy is likely getting a little bit stronger. So it's actually a lagging indicator to rates, and it's not directly tied with interest rates. So being able to understand that first and foremost is paramount in being able to describe that. So let's talk about just the Fed cutbacks. So like Rick eloquently said, we are in this new cycle of buyers, and this is an exciting time. We had that COVID special where we had very low interest rates and those prices increasing. And then we have the last couple of years, which was a lot of first-time home buyers. They have the stomach to basically take a 7 or an 8% rate because they understood that was the only market that they might be able to dip their big toe in. But now we have this new market, which is full of excitement. It's buyers wanting to jump back in, buyers wanting to move, buy more property. They know that we're in a stage where the rates are going to trend down in the next, let's call it 6 to 18 months, correct? So there's not any reports that I have seen, and I am a student of the game, that have said the rates are going to go up, at least not long term. We may experience some short-term volatility, and that's going to be natural as we go into the election, which we'll talk about next. But there is this new cycle of buyers, and that's what we need to capitalize on. Again, this is the first time the Fed has cut rates in 4 years. So there's no doubt why there's any excitement in the market. So this is the sign of good things to come. So let's talk about the short-term ramifications of interest rate reductions, and let's talk about the long-term. And I'm going to put on my glasses, so I apologize. This is what life is these days for me. Again, the Fed cut has led to lower borrowing costs overall. So when the Fed cut rates last month, that was an immediate impact in short-term to credit cards, which were in the 30%, to home equity lines, which the base rate was 8.5%, to auto loans, to student loans, which people had to start repaying last October. So they immediately felt a little bit of relief in their monthly debt. So short term, we have that impact immediately. It's also, as rates do go down, we know that is going to lead to increased competition. You're going to have, at least short term, more people jumping back into the market, and you may not have the inventory to support it just quite yet. So, again, I can't speak enough about this is your time to tap all of the first time home buyers that you know and remind them that this is their time to keep their toes in the market so that they can have that opportunity. Again, short term, I think that this is the time to get prepared now. That's the best way I can say it. You have to capitalize on this excitement. You have to be that center of knowledge of what's going on. And you have to keep all of your friends, family, center of influence, past clients, future clients educated on what's to come. Here's what we're going to see long term. So long term, we know that economists are predicting further rate cuts into 2025. So we're only just beginning to scratch the surface. This is going to be very exciting times ahead, and that's why we need to have our processes in place. Many expect the Fed's rates, it's at 5% right now. It's +3 when they lend to the public. So they're expecting the Fed funds rate to come from 8% down to 6% just by mid 2025. So I think that's going to loosen up the market for people to move freely again. They've been really handcuffed to their properties because they weren't likely to move from a 3% interest rate to an 8% interest rate, especially when the market was at least stabilized, if not increasing in a lot of our markets, right? So people just couldn't afford to make that move. As the cost of credit goes down, you're going to see more people that are able to move, and that's also going to free up inventory. So all those people that haven't been able to upgrade, here they come. We have such a pent up demand for people being able to consolidate credit. The last few years have been tough on everybody. And so people have been living off of credit cards and home equity lines and the sort. And so being able to take advantage of a lower cost of credit and consolidate debt and improve their financial situation will also improve their ability to purchase homes into the future as well. So that's the short term and long term ramifications. Now, this is when you grab your martini when we talk about the presidential election. Like it or not, in less than 2 short weeks, we are going to have a new president. And it doesn't matter which party you vote for, there is a new president. So there will be someone new at the helm of the ship. So let's talk about what the election could mean for the markets. So again, the Fed rate is, and first off, the Federal Reserve chairman is nominated by the President of the United States. So depending if there's a change in regime, we could have a change in a new Fed chairman too. And that could affect their views on monetary policy, on how quick they want to lower rates. All of these things could move much quicker than they're anticipating, right? It also will change their view on inflation and what they see as coming, because that's what causes interest rates and the Fed to cut rates is when they see they need to slow or increase inflation. So where the kind of unsurety is really a risk of a unified government, and I'll explain what that means. The market likes checks and balances. They like a yin and a yang. So they like different political parties to basically be able to talk through issues and come to some kind of agreement. If one party, either Democratic or Republican, controls all three branches of the government, it may not fare well for rates. So there could be some changes in what happens. So this is what we see coming in the very short term, in less than 2 weeks with the presidential election. One other thing that could obviously affect interest rates in the very near term is if there is social unrest after that election. If if the citizens take to the streets after a president is elected, short term, that could cause interest rates to have some volatility. And we're seeing a little bit of it now. There could be a slight downturn in market activity leading up to this. The wait and see. I want to wait and see what happens with the new president before I make such a big decision on buying a house. So again, we have an election in just a few weeks, but that president doesn't take the office until obviously next year. So there could be some short-term volatility with that. And then we, of course, know that it's not only what happens on U.S. soil, it's what happens in the rest of the world as well that affects interest rates. With wider conflict erupts in Europe or the Middle East, then potentially that could affect rates. Hostilities, if they continue between Taiwan and China. I saw something on CNN about soldiers coming over to Russia today. So that was interesting as well. So again, it's not just what happens on U.S. soil. The biggest potential could be the luxury market, the biggest risk, because you have high income home buyers that really may be more cautious in wanting to see the results before they move forward. They're going to want to see how it affects tax implications. how it affects their incomes, their stock prices, all the different things. So that could also in the near term face some volatility. So it's not all doom and gloom. In fact, it's very little doom and gloom. It's very much excitement about what's going on in the market, but it's understanding short term and long term volatility. So this is what's called the dot plot. So the Federal Reserve they meet every quarter and they meet oftentimes multiple times in a quarter. And what they do is they do this dot plot. They talk about what's coming in the short term and what's coming in the long term. As you can see, this is just from the Fed's meeting last month, September 18th. So this is fresh information, and this is their dot plot. Rick said we saw a bigger increase than was expected, a 0.5%. So they only expected a quarter. That was what was built into the market. So as you can see, as we get into 25, 26, 27, and even longer term, it's all positive news for where they see the Fed funds rate going. Again, it's not exactly tied with mortgage rates, but it's that lagging indicator and it's the overall cost of credit. So again, this leads us to the belief that there is a lot of positivity in the market and we need to get ready to run. I also love a good mortgage rate prediction. This is one from Fannie Mae, the Mortgage Bankers Association, and Wells Fargo. So some of the big boys in the industry. This was just taken on October 2nd. So again, this is pretty much fresh off the press. And again, all three have that same optimism of where the market is going to go into the end of next year. There is nothing showing that rates are going to trend up longer term. We know that we may face that shorter term volatility, but everything is optimistic for the future as far as mortgage rates. We're expected to end back in the mid fives towards the second half of last year, or next year, I should say. So that's exciting as well. Now, this slide may not have the same excitement for you as it does for me. This is actually a subprime lending slide. And it's an eye chart, but the only thing that you have to focus on is that white circle. That white circle is refinance applications. And what that white circle shows you is that refinance applications have been up 115% year over year this year. So that's great for our business. What that shows us is the pent-up demand of people wanting to tap into their real estate to purchase additional properties, to consolidate their debt, to put them in a better position, to get ready for something bigger that's ahead. So this is exciting. All of the trends are leading to a seriously improved market, which we're excited about. So I just want to talk about, just to summarize this, some key impacts on the market segments. So I'm going to talk about your buyers first. Again, what's happening with interest rates, what that means for your buyers is improved affordability. Again, as the overall cost of credit goes down, that means that maybe they can afford to move from that 3-bedroom to that 4-bedroom. So they can afford something a little bit more. So they're more likely to sell their home, and that's going to free up inventory, which is exciting. We talked about increased competition. That does mean that when rates go down, we are going to see, at least short term, some competition on homes. So your buyers need to be prepared for that and be able to put themselves in the best situation possible. But we talked about that market though. We talked about the market starting to loosen up and people being able to finally make decisions if the cost of credit becomes a little bit lower. And that's really exciting for your buyers. Moving on to your sellers, we all know what happens when rates go down. We know that means that the prices are going to go up. So your sellers are going to be really likely to move. They've already, like said, some places made as much as 40% through the COVID years. And now that's going to continue to rise. A lot of people are going to take their chips off the table and they're going to figure out whether that's moving to another state, whether that's moving to a smaller house, whether that's selling their home and paying all cash for the next property. It is going to lead to increased opportunities for those sellers as well. They aren't going to be tied to that lock-in effect of the market where they just couldn't make a move. So that will lead, more inventory is obviously going to lead to that market improvement. And then again, just as the industry overall, when buyers and sellers come together and there's more inventory and there's lower rates, we know that the magic happens. So that's going to be really exciting as well. It's just there's going to be an increase in market activity. And that's what we have to get ready to really move on. Just to get more granular with your HELOC borrowers, again, short term, they've already seen a 0.5% rate decrease. So what that means is, and that happens in real time. So their next month, their payment goes down immediately. Same with those credit card holders. So again, credit cards, I can't believe it. I kept getting these disclosures in the mail from every credit card company, just letting me know that my cost of credit was well over 30%. And that is absolutely shocking when over almost a third of your monthly payment goes just to interest if you're carrying balances. So that automatic rate reduction is really going to help our credit users as well. Let's not forget our real estate investors. So that's a huge segment of the market that you're really going to see move. So just a couple things to think about. As the cost of credit becomes lower, portfolio expansion. You're going to have these investors dip their big toes back in the market. We all know that investment properties can cost a little bit more than a primary house. They may not look as great on paper, and so they may have to go with alternative lending programs that have higher interest rates. So again, the ability to refinance that debt into lower payments and then free up that monthly payment to buy more is going to be great. Also, by lowering their cost of credit, that increases their monthly cash flow. So that makes them want to get back into the market. It's very hard in some markets to cash flow investment properties right now. People are buying it for the future. They're not buying it for what they're making on it today. It's also could potentially lead to faster flips. If there's more inventory, more buyers on the market, that could mean that people are going to come back in, buy those properties, flip them, and there'll be a bigger audience to purchase those. So that's exciting too. So again, I think those investors are going to become very critical in your book of business as an opportunity to capitalize because again, they've been sitting on the sidelines or trying to figure out stacking their chips in a lot of cases. And that improved cost of credit and improved inventory and being able to get in and out of properties quicker will lead to more investors coming into the market too. So lots of exciting stuff to come for sure. I want to turn it back to you, Rick. I want you to talk about how you take what's happening in the market and turn it into opportunity, which turns it into dollars.
Yeah. So awesome stuff, Danielle. What I hear you saying is that over the next several years, economists believe that the new era will lead to rates being reduced, not increased.
Correct.
And what's important about that is that we've just come from an era where the Fed just kept raising the rate to combat inflation. And now we're seeing the Fed beginning to lower the rates. It's a whole new game out there today. And those people who bought a property a year ago, 2 years ago, 3 years ago, I'm hearing from you that they're going to need to refinance, which is a great opportunity for me as a real estate agent to reach out to somebody. I'm not asking them, Danielle, would you like to buy or sell a house today? I'm saying, hey, where's your mortgage at? Because I'd love to help you save money on your monthly payment. Wow, what a value that we're able to provide. And then I think about the home equity line of credit that you referenced. That home equity line of credit is tied to prime. That home equity line of credit is a variable rate just every month. And there may be some people saying, I'd rather have your fixed rate, Danielle, refinance me into the lower rates that exist and wipe out my home equity line of credit. I don't want that thing anymore. And if they've got a credit card at 30% APR, there's no way they don't want to refinance that into their mortgage and be able to stretch out that payment over 30 years and then be able to reduce that interest rate. So there's a lot of opportunities in today's market. Did I say all that right? That's what I'm hearing you say.
Perfect summarization.
Yeah. And so, guys, what we should know, and I'm going to move through some of these slides really quick because I want to give you the scripts and dialogues and exactly how to say it and who to say it to. But I'll go back to the previous slide, Danielle, if you would. I just want to touch on this. Understand if you're new to the industry, and what I mean by new is you've been in the industry for a year or two or maybe three, and these are unusual times. Real estate sales for a real estate agent are at its lowest point than we've seen in a very long time. And it's fluctuating all the time. Just this morning, listed on the front page of the economic news is that real estate sales are at the lowest level that they've been in several years. And what does that mean to you? It just means there's less activity in the market. And that is all creating pent-up demand. That's the message I want you to get. There are buyers that want to buy. There are sellers that want to sell. And because of where the rate was in era 3.0, and it's going to be different in era 4.0, and because of where that was, they didn't want to lose their 3% mortgage rate to sell their house and go buy something bigger. It didn't mean they didn't want something bigger, smaller, different, in a different part of town, in a different state. It just meant that they weren't willing to leave that low rate. And that's one of the biggest reasons why we've seen this frozen real estate market and why we think it's going to start to unthaw with lower rates in the future. Notice this, your buyers are going to have more purchasing power. Okay. If we were in church, I'd say, can I get an amen? Your buyers are going to have more capacity to buy property. There's going to be a surge in buyer activity. More buyers are going to want to buy homes because more buyers are going to qualify for real estate. It's going to be a competitive environment. Welcome back to the return of the offer, a multiple offer environment that is coming. Limited supply. We already have a limited supply of inventory, and it's going to consume much of it. And we're going to see that boost to refinance activity that I talked about earlier. So next slide, Christina. Danielle.
Same thing.
On some of the other meetings that we do, we have an incredible marketer, and she controls all of our site. Her name is Christina. And so next slide, Christina. Next slide, Danielle.
It's like being
So what should you do today? The first thing that you should do is you should have an incredible relationship with a mortgage lender, because all of these things are tied to the biggest partnership in real estate. And that's the relationship between the real estate agent and the mortgage lender. I'm introducing you to my mortgage lender. If you have questions, reach out to her. She'll help you. But you need to have one, and you have an incredible relationship. And here's what we're seeing as ICC, Eisenhower coaching is seeing relationships with the agent and the lender across the country. They're more of an acquaintance. Like, we know who they are. They drop by. Maybe they bring some cookies every once in a while. Maybe they offer to take you. They're more of an acquaintance than they are a partnership. And some of them we see that there's like this reciprocal nature, but there's really not a partnership. It's like this unspoken rule. Hey, you're the best lender and I'm the best realtor in town, and let's work together and we'll be able to help one another grow our businesses and be able to better serve our clients. In this new environment, in the era of 4.0, you're going to need to have a true partnership. And a true partnership between that agent and that lender is going to be proactive in communication. You and I are the local economists. You and I are the people that our friends, our family, our clients trust. They know that we know the local market dynamics. And we need to be proactive about that communication. We need to collaborate. Danielle, you're at my team meetings on a regular basis. I come in and speak to your organization. We're constantly collaborating. We're co-marketing. We're going to show you some examples of co-marketing and how we get that message out on social media and how we're sharing these things across co-marketing channels. We build out customized solutions because this is no longer a one-size-fits-all real estate industry. And if you haven't realized that in most markets, it's becoming generational housing, isn't it? So when your buyer meets with you and they say, this is what I can afford, you may need to say, do you have an aunt and uncle or a parent or a grandparent or a child or a friend or family member that can partner up with you and buy this property? Or can we go and help you become a landlord so that you can bring a tenant along with you? Real estate's becoming very much generational housing. And especially in your urban environments, your Chicago, your New York, your San Francisco's, these markets are becoming very much multi-generational housing. It is no longer the one person or the two people buying property as a couple or as an individual. Now what we're seeing is that we're seeing families come together to acquire real estate, and it's working for them because they're gaining equity. They're increasing their tax benefits and they're paying down their mortgage. And then we got to be focused on client satisfaction. The bigger we get as a real estate organization, the more I realize the smaller I have to think. Meaning I can't think about how big I want to go. I need to be thinking about every client and their experience, because we live in a very much a consumer transparent world where people are able to read about your last client's experience. You need to make sure that you're working with a partner that provides the same kind of experience. A flat tire doesn't just impact the performance of that tire. It impacts the performance of the whole vehicle. And if Danielle drops the ball or the title company drops the ball or I drop the ball, it doesn't just impact me, it impacts their entire buying and selling process. And that's what they'll remember. So we got to have a partnership that focuses on client satisfaction. Next slide, Danielle. All right, so here's some strategies. And we're going to get a little granular. We're going to get into the weeds here. We're going to give you some quick things that you can do effective immediately. If you haven't already, you should be screenshotting this slide so that you can take it and put a part of your action plan for the fourth quarter of 2024. Put it a part of your action plan for 2025. Meet with your lender. Say, hey, these are some ideas that we can work on together. Co-host educational events and seminars. What are we doing right now, Danielle? We're co-hosting events and seminars to help our real estate community. Create targeted content. Create offers of personalized consultation. And this is a great time to reach out to your clients and say, hey, just to get ahead of 2025, can we meet to talk about your future real estate plans? Create those customized conversations. Highlight the long-term implications of owning real estate. It truly is hazardous to your wealth to not own real estate today. Address specific client segments. We need to be thinking very specifically about how we can better serve buyers, how we can better serve our sellers, how we can better serve our investors. But even think about your clients as borrowers. And you say, Rick, I don't do mortgages. I'm not saying you do mortgages, but they have a problem and that credit card's at 30%. That HELOC is completely variable and adjustable every month and is volatile. And you have solutions by working with your partners to be able to better communicate opportunities to refinance and to readjust the rate, or maybe just to move more of it into the HELOC and get it off the credit card, or move more of the HELOC into the refinancing of your mortgage so that you can have a lower payment and stretch it out over 30 years and make it more affordable, pay less interest. And we got to stay informed. I'm so glad that we got so many people on this call, so many people watching these videos, because today you really have to be a student of the industry. You must have a pulse on what's happening in the market. And let me tell you, the next time the Fed makes a rate adjustment, and it's on the front page of every online media outlet, okay, above the fold, every news outlet you go to is talking about it. You shoot a video that day. Get your lender to partner up with you. Articulate the implications. Articulate the value. Go back through and watch this video of why that's an impact when the Fed adjusts the rates. And on that same day, within the hour, shoot that video and get it sent out. You say, Rick, I'm not great at shooting a video. I don't like the way I look. I don't like this. It doesn't matter. You're the local economist. We win in real estate when people think of real estate, they think of us. Next slide, Danielle. All right, so here's some key marketing strategies, best practices with your SOI. As we work with our clients across the country, Eisenhower, we've discovered that your number one source of business is not Zillow. It's not realtor.com. It's not even Google. And yes, we're living in the fourth industrial resolution. Thank you very much. We're living through that, but still today, you and I do business with people that we know, we like, and we trust, and they do business with us. So your sphere of influence, if I'm going to prioritize where I'm going to spend my time, my energy, my resources, this one rises to the top. I got money left over in my budget. I'll go run Google local service ads. I'll go run Google AdWords. I'll go and I'll market and become a premier agent on Zillow or market on realtor.com or your farming. And we teach you how to do all of those things. But none of it happens until you're effectively, consistently communicating with your sphere of influence. These are things that we're talking about that are relevant for nearly every person in your database. Every person, whether they own real estate, whether they don't, most have either a credit card, a home equity line of credit, a desire to buy a home or own a property. And if they are owning real estate and they're thinking about what do they do from here, we should be helping them sell one and buy two. And so every person in our sphere of influence, our conversation here can bring value to them. Next slide, Danielle. Fourth industrial revolution. All right, here's some scripts. And I'm giving you 3, and we're going to give you different segments that we think are of value to you today. But what do you actually think when you're talking to your friends, your family member, or your real estate professional, and they have a home equity line of credit? What do you actually say when you're talking to home buyers in today's market? So let me give you a few scripts that I like, that we wrote, that you can use and make you feel more comfortable with this conversation. This is another one. You ought to be screenshotting this image so you have it. Let me just rattle off a few of them that I think might be helpful to you. So scripts for the real estate professional talking to somebody who has a home equity line of credit. It might sound something like this. Hey, Danielle, with the recent Fed rate cut, it's a great time to revisit your home equity line of credit terms. As you might see, lower monthly payments and save more interest over the life of your loan with a refinance. If I'm talking to a buyer, a potential buyer, they're just thinking about the real estate market, I might say something like this. The Fed's recent rate cut means lower mortgage rates, making your dream home more affordable with reduced payments. Danielle, would that be of value to you? Could we hook up and meet later on today at 4, or would 5 be better to talk about more of these details, right? Like it's that simple of a dialogue of what it means to interact with your actual sphere of influence, those who have a home equity credit, those who have a credit card, those who are interested in buying a home. What about those who are selling a home? Let's go to the next slide, Danielle.
Mhm.
All right, let's go to home sellers. Let me give you this one. It's been 1,511 days since the last Fed rate drop. And this rate change could attract more qualified buyers looking to take advantage of lower rates, making it an opportune time to list your home. Powerful script, very timely, very relevant. And it's been over 1,500 days since we saw the Fed make that rate adjustment in March of 2020. So we're entering into a new era. You'll be the one to communicate that to your team members, to your agents, to your sphere of influence. How about this one? Scripts for real estate professionals working with investors. The Fed rate cut creates a more favorable real estate environment for investment, as lower borrowing costs can boost your returns and cash flow. That's speaking the language of an investor. With the Fed's first rate drop in 1,511 days, now is an excellent opportunity, Danielle, to refinance or leverage new investment properties with more affordable financing, right? These are simple scripts that you can use. And if you've got your own, that's great, use them. But what we're seeing is that real estate agents, they're not communicating this message, and they're leaning on these mainstream media outlets to communicate it, that aren't communicating what's relevant and what's real in your market and what's to come. This is a great opportunity for you and I to communicate that. Next slide. All right, here's a couple of examples of what an effective social media campaign. Attention to home buyers about the Fed rate cut, homeowners, what they should do, people who are thinking of selling their property. By the way, a lot of people think, I'm going to sell my home the first part of 2025. I'm going to wait till next year. If they're going to get started on that, they need to meet with you now to learn how to best prepare that home for sale. They need to meet with you now to hear the transition plan. How do I transition from one home to the next? They need to meet with you now to learn what their home is actually worth so that they know where they might see their net proceeds land. Like all of these are very relevant conversations and great social media campaigns. We've got a couple of examples of what that looks like. Go ahead and change the slide, Danielle. We'll go to those. So here's just a couple of examples. These are all people that Danielle and I work with across the country. And you might even see some of your companies there. And so these are just examples of how you can get that message out by partnering with not that acquaintance, not that strategic alliance, not that I think about you every once in a while, but to have a true partnership where you're growing together, where you're working through these opportunities together. It's a powerful combination, the real estate agent and the lender. It's one of those things, Danielle, I've experienced working with you, that 1 + 1 doesn't equal 2. You and I combining our efforts is a multiplier that we're able to do far more when we work together than we could ever do apart. And you bring a unique dynamic and I bring a unique dynamic. You bring a unique dynamic and one of my agents working with you brings a unique dynamic to the conversation. And that's what co-branding, that's what partnering with your real estate professional can do. Next slide. All right, so we're going to start bringing this to a landing as we had promised. Danielle, you and I and Brian Eisenhower and Brian Donnelly, we are all in Las Vegas, November 14th and November 15th. We're not performing we're not performing at the Bellagio, if you were thinking that was the case, or at Caesars, no. But what we are doing is this is a 2-day It is a small group setting. We have room for about 35 people. We already have a lot of people signed up, but we have a few available spaces. And this is Danielle. This is me. This is Brian Eisenhower. This is Brian Donnelly. This is us sitting in a room, laptop open, building your business, building these systems. The first 2 hours, Danielle, we talk exclusively about the lender and the real estate agent partnership. We talk about the insurance agent and the realtor partnership and how to maximize that. And so if you want to sit in a room, and this is for just the right people that really want to kick off their business in 2025, they want to take their business to the next level, and they want to be shoulder to wall setting that can do that. It's powerful. Next slide, Danielle.
What's my slide? I'm so sorry. Let me get back to, I may just reshare again to make it. There we go. How's it?
I think we're good. And then I just dropped the link in the chat box. So if you're thinking I want to be a part of the ICC Regional Summit in Las Vegas, it's the last one we're going to do this year, Danielle. Nashville a couple of months ago, it was totally awesome. We were able to spend 2 days with real estate agents, leaders, brokers.
I think you faded a little bit with the earpods. Can you turn them off?
All right. Can you hear me okay?
Perfect. Thanks.
I had a little technical difficulty there. So that was in Nashville. This will be the last one for 2024. We'll be in Las Vegas, and I hope that you can join us. Go to iccregionalsummit.com to learn more. And if you don't have that kind of partnership that we've been talking about the whole webinar, okay, how do I get that? And if you do, great. High five. Man, you are way ahead of most real estate agents. Or if you really want to find a way to bolt on mortgage to your real estate business in a way that's compliant, in a way that's legit, in a way that's authentic, in a way that actually helps reward you financially as a real estate agent and broker, that's what Eisenhower Connect is all about. We saw this opportunity where real estate agents are not reaching the potential in their relationship with their lenders that they could and that they should. And we built Eisenhower Connect to do that. And you can learn more about that at eisenhowerconnect.com. And it's your way of being able to build that lender real estate agent partnership and then receive some of the benefits along the way. Danielle, was there anything more on that?
No, I think that's great. If you want to discuss that more, then just go through that website and we could set up a one-on-one appointment.
Yeah, I think we actually have what's called a personalized performance snapshot. And what that means is that you put in a few pieces of information, I think your name, your phone number, your email, how many homes that you sold, and I think it's your average price or something like that. And then Danielle goes and she actually goes through and figures out, is this beneficial to you? Would it be beneficial to have Eisenhower Connect help you bolt on a mortgage company onto your real estate business and help you be prepared for that refinance opportunity, help you be prepared so when you're talking to somebody about the home equity line of credit or about the high credit cards, you have a real solution to send them to.
Perfect.
All right, that's Eisenhower Connect. Both of those are in the chat box. If you want to click on those links, they're available. Next slide.
I think that's just our Q&A and any closing thoughts.
Closing thoughts, we're in real estate era 4.0. And for you, if you've been in the real estate business for less than 3 years, you don't know any different, but you're in a new era today. And that kicked off less than 30 days ago. And it's our opportunity to make the most of that. And you and I need to be the local economists to our sphere of influence. When they think of real estate, do they think of you? When you win that battle in the head, you win the market. You will gain market share when people think of real estate, they think of you. And so, Danielle, it's been a pleasure working with you just today, but we're actually over the last 10 years. We've done these kinds of things and these kinds of webinars and in-person presentations and educated our real estate community for the last 10 years. Today, there is more happening in the real estate business than I think ever before. I've been at this for over 20 years. I've never seen so much stuff coming at us so fast, so many changes, and it really takes a student of the market to win in real estate today. Danielle, any final words?
That's it. I think we have such an exciting opportunity ahead. So being able to really stay focused and get ready to run. That's our saying. We also have stay alive till 25. So it really is. We've been waiting for this for the last couple years. So it is just being having that base knowledge, I think will help take your business to the next level. So we appreciate your time and we hope that you found this helpful today.
Bye, everybody. We'll see you next time.